In the world of investing, there is a saying that rings true through both euphoria and adversity. Everyone's a genius in a bull market. When the markets are soaring, it doesn't take much skill to look accomplished. Almost every investment, whether chosen through rigorous analysis or hasty speculation, seems to rise. The atmosphere is charged with optimism as portfolios swell, and it appears, at least temporarily, that nearly any decision is rewarded. But that illusion of effortless success is just that, an illusion. The real test of an investor's acumen emerges when the tides inevitably shift. When markets falter and euphoric gains evaporate, the difference between luck and skill becomes unmistakably clear. As Warren Buffett so succinctly observed, only when the tide goes out do you discover who's been swimming naked. In the harsh light of declining markets, it becomes evident who had the discipline, the foresight, and the sound judgment to prepare for leaner times. To be a truly good investor, steadfast through booms and busts, requires more than catching the upward drift of a bullish tide. It demands a rigorous focus on essentials, risk management, long-term fundamentals, the rejection of herd mentality, and above all, emotional resilience in downturns. Let's explore these pillars of enduring investment wisdom. First, it begins with a clear investment strategy. Those who succeed consistently do so because they follow a defined plan. They know whether they identify as value investors, seeking underappreciated bargains, growth investors, pursuing companies with extraordinary potential, dividend investors, seeking steady streams of passive income, or index investors, spreading risk across the entire market. Successful investors resist the pull of fads and speculative frenzies. When headlines proclaim the unstoppable rise of a new technology or asset class, they remain unmoved unless careful analysis justifies that enthusiasm. They refuse to chase the latest hype because they understand that what's popular today often fades into obscurity tomorrow. The second cornerstone of true investing is understanding risk. Wise investors recognize that every choice carries uncertainty, and they make it their business to know the downside before stepping in. They diversify, not just for the sake of variety, but to protect themselves from the many unforeseeable events that can strike a single company, sector, or market. This diversification extends across industries, continents, and even asset types, reducing reliance on any single outcome. Importantly, they always seek a margin of safety in their decisions, building a buffer for errors, market shocks, or simple bad luck. But risk management is meaningless without a focus on fundamentals. Unlike gamblers, shrewd investors analyze the real operations that underpin stock prices, earnings, cash flows, balance sheet strength, return on equity, and the burden of debt. They study business as a whole, investing only in companies with durable advantages and leadership they trust. They approach every investment as part owners, considering not just the stock's price chart, but the underlying enterprise and its future prospects. To them, shares represent slices of real businesses, not mere trading chips. Emotional control forms the backbone of the fourth pillar. It's easy to remain rational when markets climb, but the true challenge comes amid fear, panic, and relentless negativity. Good investors don't panic in bear markets. Instead, they welcome volatility as an opportunity rather than a threat, holding steady when others flee. Just as importantly, they resist euphoria during booms, remembering that unchecked greed can be as destructive as paralyzing fear. They refuse to capitulate to headlines designed to provoke reactions, whether optimism or dread, and instead make decisions based on facts and analysis, not their own or others' fluctuating moods. Another key element of lasting investment success is a long-term perspective. Short-term noise, the daily squalls of news, rumors, price swings, does not distract them from their end goals. They see the market as a vehicle for compounding wealth over years and decades, not a casino for overnight riches. This patient mindset allows them to benefit from the power of delayed gratification, buying and holding high-quality assets through thick and thin. Rather than gambling on short-term trends, they place their trust in the steady growth of companies and economies over the long haul. Prudence around leverage and self-confidence forms the sixth vital habit. Wise investors resist the lure of borrowed money, understanding that leverage not only amplifies gains, but also magnifies losses. A single wrong move while leveraged can wipe out years of hard-won returns. They refuse to play with fire by overusing margin or esoteric financial products they don't fully understand. Just as important, they avoid the pitfall of overconfidence. Succeeding in a bull market does not mean they are suddenly smarter than everyone else. Past gains are celebrated, but never mistaken for infallibility. This humility keeps them grounded. Seventh, the habit of rebalancing a portfolio ensures enduring discipline. As markets shift, some investments swell in value while others lag. Successful investors periodically review their holdings, trimming positions that have become overvalued and redeploying capital to areas where quality assets are now underappreciated. This process not only locks in gains when valuations become stretched, but also keeps their risk profile aligned with original targets. In practice, this means selling high and buying low, doing the opposite of the crowd's instinctive reactions. Continuous learning completes the picture. The world changes and markets evolve, and so must the investor's thinking. The very best investors are also students first, constantly reading, reflecting, and seeking to deepen their understanding. They pore over the words of investing legends, Warren Buffett, whose patient logic is the benchmark for prudence, Charlie Munger, whose wit and wisdom illuminate interdisciplinary thinking, Peter Lynch, who championed knowing what you own, John Bogle, the father of low-cost index investing, and many others. They review their own past choices as well, learning from both mistakes and successes. Above all, they remain humble and curious, for arrogance is the enemy of improvement. When you integrate all these principles, you build an approach to investing that can weather the inevitable storms. Markets will rise and fall, often unpredictably. Fads will come and go, but the disciplined, educated, and humble investor remains. Such an investor plans meticulously and sticks to that plan, adjusting only when careful logic dictates, understands that risk is unavoidable, and takes proactive steps to protect every dollar, prioritizes business fundamentals, and makes decisions as a part owner, not a speculator, manages emotions with vigilance, relying on analysis rather than impulse or groupthink, looks far beyond the next quarter or headline, focusing on the journey of years or decades, avoids dangerous shortcuts like leverage and tempers self-belief, with a firm grasp of their own limits, rebalances their holdings with diligence, ensuring no position grows out of proportion or becomes neglected, engages in lifelong learning, drawing from both classic wisdom and the lessons of today. This mentality not only increases the likelihood of financial success, but also brings peace of mind. When you measure your progress against enduring principles, not fleeting returns or fads, you remain resilient even as others falter. During intoxicating rallies, you avoid the dangers of overconfidence. In periods of turmoil and loss, you find the strength to hold your ground, knowing that your process is sound. History is replete with examples supporting these truths. Those who abandoned discipline during booms, piling into speculative assets at any cost, often suffered severe losses when reality reasserted itself. Conversely, those who maintained a commitment to value, diversification, and patience weathered the downturns and emerged stronger. Consider the world's greatest investors. Their fortunes were not made by chasing wild manias or panicking during crashes, but by adhering to the principles described here. In short, real genius in investing does not reveal itself in easy times. It is forged and proven in adversity. Every investor must ask themselves, when the tide goes out, will I be found swimming naked, or will I stand secure, buoyed by preparation, knowledge, and discipline? Becoming that rare kind of investor is not about picking a handful of big winners. It's about cultivating good habits, developing a strong mindset, and building an approach that endures through changing times. Whether you are just starting or have considerable experience, the same foundations apply. Stick to your plan. Always mind the risk. Dig beneath the surface for real value. Temper emotions, especially when stakes are high. Keep your gaze on the distant horizon. Respect the market's ability to humble even the brightest minds. Refine and rebalance, keeping your intentions clear. And above all, never stop learning. Remember, the market is a great teacher, but its lessons are often expensive for the unprepared. Approach every investment with vigilance and humility. Rejoice in success, but never attribute it solely to your own brilliance. Luck plays its part, and so does timing. Similarly, accept the reality of losses, using them as fuel for insight, rather than as a source of despair. In the end, what separates the transient geniuses of the bull market from the truly great investors is not flair or luck, but the quiet rigor of preparation and the calm courage of discipline. If you can master these principles, you can thrive not just when the waters are warm and the current is strong, but when the tide retreats and only true skill remains. Your investment journey is your own, but the lessons of those who have come before are there for you to use. Apply them with diligence, and you too can rise above the crowd, whatever the market brings.